Hey, welcome all. Welcome to the Small Business Development Center of North Idaho. Our webinar this morning is What's Your Business Worth? And John Hammett is our presenter. I'm going to turn the time over to him as we get started. You're all on mute, but if you need something, please double check and make sure that you're on mute right now. And then if you need something, use your chat and we'll turn the time over to John. John, are you ready?
I am. Yeah. Good morning, everyone.
Thank you, John.
Thank you. Thank you, Katrina. This presentation is put on by the North Idaho Small Business Development Center here in Coeur d'Alene. The SBDC is a national program run by the Federal Small Business Administration, and our office here also receives funding from the state of Idaho, North Idaho College. We provide services to business owners in the panhandle here in two ways. We provide educational opportunities for company owners, and that's what this is all about today. And the second way we serve business owners is we provide one-to-one coaching on a monthly schedule to individual clients to check in and coach them over questions that they may have in their business. My name's John Hammett, and I'm one of the business coaches here in Coeur d'Alene. I joined the team early this year after retiring from a 40-year career with private companies and their owners. I've owned two of my own companies. I've been a hired executive for private companies in Massachusetts, Minnesota, and California. I covered the continent here. And I spent 20 years as an investment banker, helping private company owners maximize the value of the company when they wanted to exit. So today is what is my business worth? I welcome questions throughout. If you have a question, I'll put it through in the chat function. And I'm going to talk with you about ways that business people put a value on businesses. I'll show you two different approaches to establish value for companies. And at the end of this, I'm going to tell you about specific characteristics that drive the value of a company up or down. And that's not only for when you want to exit, but it improves your business every day in the process. So why do you care about valuation, right? What's important about that? Well, eventually, everyone exits their business. We make a joke in the business world about everyone exits. Sometimes it's feet first, and sometimes it's walking out with a pile of cash. So it's good for business to track whether you're building value on the way to that event. And so some of the tools I'm going to give you here, you can look at on a regular basis, even if you're not thinking about selling your company right now. So we focus on long-term value to improve your profits now and into the future. And we're going to talk about characteristics that raise or lower the value for buyers, that raise or lower the everyday value of your company to you. So if you can start now on the focus of these key value drivers, you'll find positive effects in your business. So I keep running through questions here, right? So what's my business worth? Well, it depends. There's not a single answer to this. It really depends in the case of businesses about who is asking. Every day people are thinking about the value of your company. And the same business has different values for different people in different businesses. We're going to take a look at that here. Here's 9 different outsiders who may have an interest in your company. Starting up, it's sort of a random list of things. As we go through here, you'll understand the difference among them. But we start with the current owner, which is you. And what's it worth to you? The basic answer to that is it's the value of the money that you're going to earn until you retire, plus whatever someone might pay you to buy the company at the end. Let's take another. What about your insurance company? All they care about is having to write a check when something bad happens. They don't care about your profits. They just want to know about you avoiding risk. A new startup is an interesting thing to think about, and we'll get into that in more detail later. But the value to someone who wants to copy your business, you'd have to duplicate the value of the assets used in your business and save time and money to build to your size. Local competitors, it seems like owners often say, well, I've got a competitor across town and he'll buy me when the time comes to retire. It's actually one of the lowest value buyers to consider. It has negative synergies. People buy from your competitor because they don't like you, or they buy from you because they don't like the competitor. But if you're carrying the same products, providing the same services, there's no synergy. It's only negative synergy if it's a local competitor. In the middle here, how about the owner's children? It's the American dream, right? Pass it along to the next generation. But do they really want to own it? If they're still growing up, maybe they want to be a rock star. I had a client actually with a son who became a national rock guitarist and toured the country, and that was what he wanted to do. Somebody might want to be a scientist or a fireman. So make sure if you're thinking about passing on to your children that there's a conversation about it. I had a client once who was 70 years old. He sold the company to his son when he was 60. The son ran it for 10 years and said, I don't like it anymore, Dad, you take it back. So there are some risks there sometimes if it's not thoroughly thought out. Lenders, your banks, they got a real interest in your success at some level. What they're interested in is making sure you pay back the money you borrowed. They care about having enough assets in your company and maybe your house if they're looking for that as security. And what happens if they need to shut you down to get repaid? In my career, I've had 2 banks fail on me. And when that happens, the FDIC comes in and says, that $2 million term loan over the next 5 years, you got to pay it now. And in one situation, that bank took 8,000 private companies out of business because they couldn't repay their loans. Current employees, it's certainly valuable to your employees as well. It's the source of their wages. And if they have, so they have a similar interest in your success and healthier company in the future, and they may want to buy you out someday when you're ready and when they're ready. Synergistic businesses are really the high value transactions. These are companies where 1 + 1 makes 3. I had clients that were in Minneapolis. They were in the HVAC business. One of them, they're both commercial. One of them did boilers and heating systems, and the other one did air conditioners and cooling systems. They knew each other, but they'd never they'd never shared business with the same customer. They each were earning about $500,000. When we put the 2 together, there was an additional $500,000 in savings and rent. They happen to have had the same landlord, actually. And so that was a synergistic business where it was high value to both clients. And finally, equity investors, you may see them around if your company is bigger. If you have money invested with them, their interests are pretty close to yours in terms of building value for the exit. But that's where they get paid, is when the deal is, when they sell it to the next company. And you have value for that at that point too, but you also need to include your earnings. So high value for equity investors is also a quick exit. The return on their money, if they anticipate selling the company in 5 years and they can sell it in 3, it raises their return on investment. So sometimes they may force a sale of a company. So there's 2 different approaches to value that we're going to talk about. The first is what I call static value, and it's the value based on the balance sheets of the company. And I'm going to try and get through a little bit of accounting here as we look at this. And it includes things for assets that are like cash and equipment. Here you can see we've got a truck, we've got a factory equipment. If you're running a daycare, you may have furniture and fixtures there that you need to buy. And the liabilities is money that's owed to others, like unpaid purchases made on credit cards, and long-term liabilities like a mortgage or a term loan. The other valuation approach we're going to deal with this second is what we call dynamic value. And that comes from the income statements. Dynamic value puts a value on the future earnings of the company. And it considers the risks that bad things happen and good things happen that may make the future earnings different. So we're moving now to the balance sheet. Talk about the static value. The balance sheet gives a snapshot in time of the assets and the liabilities. And the value of the company is going to be the difference between the positive assets and the negative liabilities. Here in the upper left, we see current assets. These are things like the cash in your bank account, amounts that your customers owe you for your work or your products that you have delivered to them. Inventory might include completed goods like finished products. It also includes things like raw materials that you may have bought to turn your finished products in your business. Prepaid expenses are things like the security deposit on your leased space. Typically, your insurance is paid early in the year. You don't have to pay that every month. Here, long-term assets, things like furniture and fixtures that you need to invest in to last for 5 or 10 years. So they're considered long-term assets. Machinery and equipment, if you're in the manufacturing business, and if you happen to own the real estate where your business is, it includes that as well. If you think about it like your home business, the cash account is to pay your future bills. Money you've earned at work but haven't yet been paid would be an accounts receivable. And the food in your fridge is inventory, and early payments you may have made for your homeowner's insurance would be a prepaid expense. Long-term assets includes things like a car, your home, if you own it. So these are all the good things. Let's take a look at the liability side. Current liabilities are unpaid balances on the company credit card for things you may have already bought. It's money that's been borrowed through a bank line of credit. And it might be amounts owing to suppliers of your materials and services. It's common to give business to business 30 days payment on delivery of materials, but those are accounts payable that you have to pay off sooner or later. Think of it personally as the outstanding balance on your credit card and money you have to pay after the fact, like utility bills. You've already consumed the utility, but you have a liability to pay for that. Long-term liabilities, things like capital leases, long-term debt. They might be leased vehicles. It might be borrowing for heavy equipment that you've had to install. And it might be a multi-year term loan for the company. The difference between the assets and its liabilities is known as owner's equity. Equity is the net value of the assets minus the liabilities. In most cases, in healthy companies, the value of liabilities is less than the value of the assets, and equity is a positive number. In accounting terms, this is called book value or the owner's net worth. So here we go. Get your reading glasses on. I put together a model here throughout this presentation. These are the balance sheets of a company that's in the manufacturing business. So we've got cash on hand, accounts receivable, inventory, prepaids. We've been through that. Equipment. The depreciation is, accountants take a part of the equipment value every year and depreciate it. So it may be it's a 5-year life on this particular equipment, then it would be $60,000. We want 1/5 of that every year is accounted for as depreciation. And total assets, $1.3 million. Liabilities, short-term borrowing. They've got a line of credit here. We've got accounts payable to vendors, accrued expenses like payroll, and then a long-term debt that came from a loan to buy the equipment of $700,000. So the liabilities are $785,000. The owner's net equity in this example is $515,000. That's the value of a living, breathing company. Let's go into the worst case scenario. If your bank's got a problem and you got to shut the company down, what's it worth? Well, cash in the bank, the $35,000 is still there in the bank, but accounts receivable, typically if you have to shut a company down, your owners or your buyers sometimes forget or put off paying the bills, and it typically is worth only about 2/3 to 1/2 of the amount that's outstanding. Inventory takes a bigger hit because it's unique to the company, and oftentimes you can lose 2/3 of what you paid for the inventory. So you can see that here in the example went from 60,000 down to 18,000. Prepaid expenses, company insurance, rental deposit, all those things are worthless in this scenario. You've paid in advance, but you're shutting the business down. And so those assets are not an asset to you anymore. The other bad news is that the liabilities don't go anywhere. The owner has to pay those off or risk legal battles. If your accrued expenses include vacation pay for employees, the government will be sure you pay 100% of that to the employees. And if you don't, they'll send you to jail. So we take a look at this simple shutdown, and it's taken the net value down here to $21,000. It's basically worth nothing at that point in the exit. So you want to avoid that, obviously. Here's another way to look at it. Let's say there's someone who wants to start up a company like yours. What's it going to take for them to start it up? They'd have to put working cash in the bank. They have to carry the customer payments, the same as the baseline balance sheet. They got to buy the same inventory and make the same prepaid expenses. A new company might get a little bit of help with the prepaids because it's coming at the end of or at the beginning of the business. And in this scenario, then the new company will be able to carry some accounts payable and accrued expenses on the balance sheet. But in this scenario, a new competitor will have to spend $1,345,000 to duplicate the assets that you have, which takes us to the next slide. It's the same as the front column. It's called a going concern. In this situation, the company is already working with its assets and its liabilities, and it has a couple of liabilities on board for helping to finance the operations. So instead of an investment and risk of starting a new company, someone interested in your company might choose to buy it and assume the existing debt. And the investment there is 40% less than it's 40% of the total cost if they had to start it up fresh. In the deal-making world, we say that buying a company is faster, cheaper, and safer than starting from scratch. And I know some businesses, some entrepreneurs worry about an employee going out and starting a competing business. The cost to do that and the risk is really quite high, and it's highly unusual for a customer to leave and become a direct competitor. Okay, any questions about static value here? Into the chat? No, we're good. Okay, let's talk about dynamic value now. It's based on the income statements, the profit and loss statement, not the balance sheet. And I'm going to walk you through some more accounting here. But this is a quantitative kind of a discussion about valuation. The dynamic value, it's all about past profitability and the future profitability for a new owner. Here's the income statement for the same company looked at the balance sheet. And if you look at this example, it's a company selling $2 million a year in revenue. They got a cost of goods sold of 65%. So their gross profit's 35%. And then a long list of expenses here. They got the owner's salary, the owner's perks. Those might be a company car or extra insurance, something that the owner pays to himself to shift some of the expenses into his deductible business rather than having to pay it personally. Got wages for employees, benefits, insurance, all the way down here. Down to the bottom, there's interest on debt. That's what the company is paying for the term loans that they had. And then depreciation and amortization, that $60,000 is what we saw as an accounting industry for depreciating the assets. This ends up with a pre-tax operating income of $120,000 a year, or 6% of revenues. So whoever owns the company gets the bottom line earnings for as long as they own the company. That's the concept of being an owner. And so that's the perspective from which we want to look at the future value of the company. Has anybody heard the term EBITDA on the chat? If you hear that at a cocktail party, you know that someone's talking about selling their company. It's the standard evaluation used in most merger and acquisition transactions. EBITDA stands for earnings before interest, taxes, depreciation, and amortization. The owner gets the bottom line income, which is nice. But EBITDA is a simple way to measure the cash flow of the company to compare it to other companies. So it's not just the bottom line earnings here. Typically, the seller will pay off the debt when a company is sold. Sort of like you have to pay your mortgage when you sell your house, and the homeowner buys it debt-free. It's the same on a business balance sheet here. So the historical interest is added back to the bottom line pre-tax earnings, the $20,000. The new buyer can arrange their own financing if they want, and they'll have to pay their own interest on that. The taxes, we're sticking with the terminology here of EBITDA, so that's interest before earnings and taxes, and that's applied if it's a public company that's paying taxes inside the company. Most private companies are flow through, so the income isn't taxed at your company, so the operating income is already pre-tax. And then the last is adding back to depreciation and amortization. It's added back because it's not a cash expense for that year. It's an accounting treatment that reduces your taxes because it reduces your income. But it's because it's a non-cash transaction. It's added back to do the EBITDA calculation. So we started out with $120,000 pre-tax earnings. We added back 20 grand of interest and added back 60,000 of depreciation. Now we got a $2 million cash flow, $2 million EBITDA company. And you see those here in the green. We didn't talk about this one up here. We're going to go to that one next. In addition to EBITDA, we have what we call adjusted EBITDA, and that's adding back company expenses that really related to the owner. So if this were a company that's run by a big corporation, they're not going to let the general manager have a company car and special health care benefits. But in a private company, that's very common. And so that number is added back as well. It's not just EBITDA, but it's adjusted EBITDA. Other things can get added back, or things like if you have your own children on the payroll and to put money away for them for college, that would be added back if it's not part of the core business. Where'd it go? Got ahead of myself here. So then buyers and sellers, they multiply this adjusted EBITDA by a number that's known as multiple, with a capital M, to compute the value of the company. So in this example, we've got a company of $212,500 of adjusted EBITDA, and it might be multiplied by a multiple of 4 to get a valuation of $850,000. So if you're following me here, you say, well, where'd the 4 come from, right? Why is it 4? Why isn't it 5 or 6 or 2 or 3? And the answer is there's a lot of things that affect the multiple. The first thing is that size makes a difference. And the irony of this is that big companies are worth more than small companies. They typically are more stable. They have depth in management. If they're being courted by strategic or institutional buyers, they actually want to put more money into a deal than less money. And smaller companies are riskier and owner dependent. So this is a table that I've put together, and it's a fairly common set of ranges. If your company's earning greater than 5 million, multiples are 5 to 10 times. It's greater than $1 million, it's a little bit less. It's greater than $500,000, it keeps going down. And in this scenario, we're looking at a $212,000 adjusted EBITDA, which is greater than the 100,000. So the expectation is that the multiple is somewhere between 3 and 5. That's why I picked 4. It's right in the middle of this range. So if we apply the multiple, you got the operating income at 120, the EBITDA at 200,000 and the adjusted EBITDA at 212. So 3x multiple, the company's going to be worth, based on adjusted EBITDA, something like $640,000. At the bottom end, at the high end, more than $1 million. This is how it looks. On the left, you get the book value number, $500,000. You get 3x cash flow at $640,000 and 5x cash flow over $1 million. So this dynamic method of valuation is better than just simply looking at two balance sheets. A lot of times accountants will just say, we'll just take your book value and that's what the company's worth. And it's certainly worth more if it is profitable. So why is there the range? Every company is different. Every buyer is different. The buyer's sense of risk is always different from the seller's. The seller knows, because he's owned the company for a long time, and is comfortable with the risks. But buyers getting someone new tend to have a lower risk tolerance. Let's take a look at the revenue history. And this will become, as we get through this, you'll get more clarity on it. You see this gray line here, that's a steady 10-year earnings of $212,500, which comes from our example. So if the company's been doing that every year for 10 years, what's the expectation of the future going to look like? You probably expect it's going to be the same. And so what's the risk? If it's that flat historically, it's probably pretty safe. What happens? Here's the same company with the same adjusted EBITDA at the same 212,500. Take a look at that history. They're at the same place at the end. But what do you think about that value? It's not going to have the same multiple as the company that's got the flat history, because a buyer's going to look at that and say, why am I trying to catch a dropping knife here? It's only going to get worse. The other scenario, again, the same ending point, exactly the same $212,500. The company's grown into that. This curve is about 7% per year compound. It's going to get a higher multiple than the other two on this. And of course, there's always kind of the last one to look at here. What about the uneven history? Who wants to buy that company? Maybe you do. Maybe there's some reasons for that, but it's certainly a questionable financial history. Starts and stops at the same point, just like the flat history, but it's something else is going on that's affecting that valuation. And now I'm going to get into things that are good news, bad news. So it's sort of, in addition to historical trends, there's a whole range of internal and external factors that affect the risk of your business. There's things that are good news that drive value up, and things that are bad news that drive value down. I put together a table here that shows both of those, the good and the bad, in no particular order. I'm just going to kind of walk through these one at a time so we can talk about them. But these are things that are important to you today, whether you're going to sell the business now or never. These are things that do reduce risk, and they increase the value of your company. So the first is a positive is if the owner is not essential. I could have said this is a negative if the owner is the only guy that knows anything. That's a low value deal. So to have higher valuation, it needs to be separated from one individual, because if the value is hung up on that person, it's not going to be worth much to someone else. The other side of that is cyclical or seasonal businesses, and that's the yellow up and down on the graph there. There's things that are seasonal. I had a client who was in the high school yearbook business, and they lost money January, February, March, and May. They made a pile of money in June, and then they lost money July, August, September, October, November, December. That's highly cyclical. and they had to have confidence that they could work off of their cash in the bank to keep them going when it wasn't their revenue period. Cyclical is something like the auto industry, goes up for a couple of years and it comes back down. And cyclical businesses can be riskier to other investors because you don't know when it's going to go up and when it's going to go down. So the good news side of this, gross margins, if they're bigger than 50%, it means you've got a high value proposition. You're getting a good spread between what you're paid by your customers and what your costs are. Not many companies can get to 50%, but if you can, that's a very strong addition to the value. And then as we saw, size matters to the earnings. If they need to be at least over $100,000 for small companies to really be able to attract a buyer. The bad news here is collectively bargained. I'm old enough, I've run two companies with unions, and that just adds an extra bit of uncertainty to the company and the company's direction. It's not so much anymore, but things that are out of the owner's control can be a risk, and that reduces the value multiple. Intellectual property promotes high margins and has got less competitions. The same with proprietary products. Intellectual property, things like patents and proprietary products are maybe not patented, but they're unique to that particular company. On the bad news side of this, environmental problems can be a deal killer if there's something going on in your property or in your process that is affecting the environment. That's a big risk factor for people, and that really drives value down. Same with lawsuits, both old ones and new ones. New ones obviously are an issue. Someone wants to buy the company, and just a history of having old past lawsuits is a negative for buyers. Recurring revenue business, that's a classic, and it's a high value business. The standard example of that is a health club. You get your membership, you get charged every month, whether you go to the health club or not. And it gets charged on your credit card, so you don't even have to reach in your pocket. And it just goes along, and the health clubs love that recurring revenue business. Other things that are like that are things, service businesses like lawn care and landscaping, that it's going on every year or every month of every year. And we see a lot of landscapers that landscape in the summer and snowplow in the winter. On the negative side, good internal financial information, good tools that show what you're doing, the money you're making, are really important to the valuation to someone from the outside. So it's important to put those in place. They don't have to be highly complicated, but they do have to be relevant and current, and include all of the costs and revenues that you're generating. Customer concentration, if you've got a top 3 customers or more than 45% of your business, that's a high risk situation to be in. So too many eggs in one basket. I worked for a company that had 85% of their business with a single customer. Customer brought in a new supply chain guy who said, we're not dealing with any new customers going forward that can't deliver our products to China, where they're put into the finished product. And that company lost 85% of the revenue in a 60-day period. I had to lay off 300 people in that. They just had too many eggs in one basket. The other side of that is single source suppliers, which is too few baskets for your eggs. Companies that depend on a single supplier or 2 small suppliers are always at risk of having a problem. The supplier could go out of business. They could get bought by somebody else. So having second source suppliers is very important to reducing the risk. Large market share is good. It shows that you're doing well in business if you've got a large share of the market. It also helps keep competitors from jumping into the business. And for some companies, good location is important. You get better customer traffic. Or if it's out in the countryside, if you're in manufacturing, you avoid the risks of urban issues. And on the negative side here, big investments for heavy equipment creates debt and it creates risk. I advise people to lease heavy equipment if they can, so they don't have the big investment. Companies with long supply chains have to carry more inventory. It means they have to finance more working capital, have to borrow money from the bank sometimes to build inventory. Companies with delayed collections can also consume working capital. I think of my physical therapist who has to, she works me over once a week and then bills Medicare and the insurance company, and she has to wait for those guys to pay their bill in 30 or 60 days. So it seems like a simple profession to be a physical therapist, but the cash management of that can be tricky. And then the last, at the bottom here, high future growth prospects are always important. Remember those charts we did of the history of companies in different situations. So future growth prospects drive the value up. And being in a growth industry, if you're in internet business that's growing rapidly, that's helpful too. It pulls you along with it. And then the last negative I've got here, strong competitors. If you're nibbling around the edges in a big marketplace, that can reduce the value of your company. So simply said, the dynamic value is expected future income to the owner, adjusted for the future risks. And focusing on value today is good for your business. And remember, it's driven by two factors: the current earnings and lowering the risk of future earnings. We got through this here fairly quickly this morning, and I've got time for questions and answers. So let me wrap it up here, and then I'll open it up for questions. We are our mission here at the Idaho SBDC is to create a strong and valuable companies. We've got upcoming classes. Tomorrow there's a class on marketing strategy. Next week, financial reporting. Mid-month, how to hire great employees in digital marketing coming up. And if you would like one-to-one business coaching with someone like me or others on the team, call this number and we can set you up with an initial meeting. So Katrina, can we open up, or let me just pull up my my chat box here. And
of course, yeah. If you have questions, you can unmute yourself, ask a question, or type it up in the chat. John's got a wealth of information here, so take advantage.
Wow.
You either blew them away or they answered everything. So
well, thank you all. Thank you. Yeah.
Yes, if any of you want to get a hold of us and set up some coaching, that number down there, or check out our website, nisbdc.com, for some training opportunities or to sign up for coaching. Thank you, John. It's great.
Thank you, everyone. Okay. Thank you. Bye-bye.